ETF vs mutual fund. What makes exchange-traded funds a popular investment choice? Exchange-traded funds, ETFs and mutual funds are two of the most widely chosen investment vehicles, but they function differently in terms of management style, cost, and trading flexibility. Mutual funds are typically actively managed, with fund managers making decisions to try and outperform the market. Recently, passive mutual funds like index funds have gained traction due to their lower cost structure. On the other hand, ETFs generally mirror the performance of an index or sector benchmark, following a passive approach. The most notable difference lies in how they are traded. Mutual funds are priced and transacted based on their net asset value (NAV), determined at the end of each trading day. In contrast, ETFs are listed on stock exchanges and can be bought or sold at market prices at any time during market hours, similar to individual stocks. This intraday trading feature gives ETF investors greater flexibility to act on market movements. Additionally, ETFs usually come with lower expense ratios compared to actively managed mutual funds, making them a preferred choice for investors focused on minimizing costs. Both mutual funds and ETFs serve different financial strategies and risk appetites, providing ample options for building a balanced portfolio. Key differences between ETFs and mutual funds. Investment strategy. ETFs are mostly passive instruments, designed to track specific indices or assets. Mutual funds are often actively managed, with professional managers aiming to outperform market benchmarks through active trading decisions. Trading style. ETFs trade on stock exchanges throughout the day, offering real-time pricing and liquidity. Mutual funds can only be purchased or redeemed once daily at the NAV calculated after market close. Cost structure. ETFs typically feature lower expense ratios because of their passive nature. Actively managed mutual funds charge higher fees due to the research and decisions made by fund managers. Liquidity and access. ETFs offer high liquidity since they can be traded like stocks. Mutual funds suit investors who prefer not to trade directly in the market, as fund houses manage the transactions. Investment planning. Investors can use tools like SIP calculators or lump sum investment calculators to plan their mutual fund or ETF investments effectively. What makes ETFs a popular investment option? ETFs have become a go-to choice for many investors due to the following advantages. Diversification. Each ETF typically holds a basket of securities, spreading risk across various sectors, industries or asset classes. Low fees. ETFs usually have lower management costs compared to actively managed mutual funds, helping investors retain more of their returns. Intraday liquidity. Since ETFs are traded on exchanges, they can be bought and sold throughout the day, offering flexibility in managing positions. Transparency. Most ETFs disclose their holdings daily, enabling investors to see exactly where their money is allocated. Versatility. ETFs provide access to a variety of strategies, whether it's sector-specific, thematic investing, or even inverse leveraged exposure. Swipe left for next video. Tax efficiency. ETFs often generate fewer capital gains distributions, making them more tax-friendly compared to many actively managed funds. Accessibility. ETFs are available to both retail and institutional investors. Many platforms now offer commission-free ETF trading, making them easier to access. Latest blogs.